Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to this week's Through the Noise podcast. I'm your host, Michelle, investment strategist in our Chief Investment Office. So over the past week, we've seen some major movements in the market. For instance, ongoing tariff concerns and recession fears have led risk assets to decline quite substantially. So the question now is that how to weather across the current market conditions? With me here today is Rajat Bhattacharya, our senior investment strategist, to discuss more on the topic. Hi, Rajat. So the recent U.S. stock market drawdown on concerns about President Trump's policies has raised question about how much further downside we're likely to see. Is there a Trump put and where is it?
Hi, Michelle. Glad to be here. So, 2 weeks ago, we raised the prospect that President Trump may tolerate a moderate economic slowdown if that helps him achieve his primary objective, which is lowering bond yields and the dollar. Now, lower bond yields and a weaker dollar will help him implement proposed tax cuts and his other pro growth policies. Recent comments from Trump and his Treasury Secretary Bessent confirm our concerns, unfortunately. As a result, the S&P 500 index has undergone a 10% peak to trough correction since its record high on 19th February. It has now broken below its 200-day moving average, also the 50-week moving average, I must add. The primary driver is concern that Trump's agenda, including deregulation and cutting government waste, using tariffs to win concessions and investments from foreign parties, and curbing immigration, are starting to hurt consumer and business confidence. Now, Trump's latest comment, which where he said, "What I have to do is build a strong country. You can't really watch the stock market," within quotes, suggests he is willing to risk short term pain to pursue his policy agenda. Now, this suggests a further 4 to 5% near term downside for US stocks. On technical charts, the S&P 500 index has next support at 5302, followed by 5082. This is where the so called Trump put is likely to be. In other words, Trump is likely to reverse some of his contentious policies at these levels as the pain threshold is reached.
I see. So under this backdrop, right? So do you see any opportunities from the ongoing equity markets downturn?
Yeah, I would say we do believe the U.S. equity downturn is an opportunity for long-term investors. This week's data shows the U.S. job market remains healthy, and with a healthy job market, you can't really have those recession fears that people are talking about. Not yet, at least. Now, disinflation also continued in February. A healthy job market should support consumption, and retail sales data next week should show a bounce back from January's weather related slump. Add to that easing financial conditions due to the sharp decline in bond yields and the weaker dollar, and we see still low risk of a near term recession. Although the Fed is likely to hold rates next week, it has enough leeway to cut rates if growth slows sharply. We also expect Trump to extend personal tax cuts expiring this year and reverse his hawkish fiscal spending and trade policies if equity markets fall another, let's say, 5%.
Got it. So here I have a more technical questions, right? So historically, what were the 6 and also 12-month return following a 10% decline in the US equities from its peak? And which sectors would be most impacted if this sentiment worsens?
Yes, actually, my equity colleagues did this math while we were, discussing this drawdown this week. So since 1970, we have seen 24 instances of the S&P 500 index correcting by more than 10% from its all-time high. Such corrections were followed by a recession in the next 6 months in only 7 instances. So, 7 out of those 24 instances of such corrections, we saw a recession. After a correction that is followed by a recession, the S&P 500 would go on to deliver an average return of 2.3% or 1.9% over the next 6 or 12 months. If the correction is not followed by a recession, the average returns are 10.8% and 14.4% over the next 6 and 12 months. On an unconditional basis, the S&P 500 delivers an average of 4.6% and 9.4% over a 6 and 12-month period. So overall, with all of this, we can infer that recession occurs in the minority of cases following such pullbacks, and US equities generally go on to deliver better than usual returns following a 10% pullback if the economy can avoid a recession. But as expected, returns would be lower if a recession does materialize.
Okay, so that is very interesting to know. But what if the economic situation deteriorates, and how should investors mitigate such risk?
Yeah, that's a fair question. So, while our base case is no recession, conservative investors can protect any equity downside through US government bonds, which are still paying healthy yields. And then you have defensive equity sectors such as consumer staples, equity, and utilities, and alternative market neutral strategies within a diversified portfolio. Now, exposure to non US assets, including the safe haven Japanese yen and cheaper euro and China equity markets, which should benefit from increased fiscal spending, may also help reduce portfolio volatility. We remain bullish on gold on structural demand from central banks, and this call has worked well for us for a long time. Now, gold and commodities are likely to do well in a stagflation scenario.
Got it. So perhaps let's shift the focus a little bit to Europe. You've just mentioned about European stocks, and they have performed very well this year. What are the drivers, and how should investors position in Europe?
Indeed, European equities and euro have both benefited this year as investors rotated away from the more expensive US stock market and reduced their bearish positions on Europe as the region's prospects have improved. Now, President Trump's pressure on Europe to boost regional defense spending as he forced Ukraine to agree to a ceasefire with Russia is likely to lead to far reaching changes in our view. One of the fallouts we are already seeing is Germany's incoming coalition partners proposing to ease constitutional debt limits to enable higher defense and infrastructure spending. While they still require the support of other parties for the two-thirds majority needed to make constitutional changes, these developments are potentially structurally positive for Europe's growth outlook. However, I must add, European assets are showing signs of fatigue with increasing risk of a near term pullback. Investors with no exposure to the region could use any such reversal and a bounce in the dollar to build positions in European equities.
I see. So, similar to European stocks, right? We also see some upbeat momentum in China equities over the past 2 months. So the question is that what is our outlook in China equities and particularly its technology sector, especially if we're heading into the fourth quarter of 2024 earnings season?
Yes, China tech sector has performed really well, as you mentioned, and we have been bullish on this area for quite many months now. The emergence of China's low-cost AI-powered chatbot DeepSeek has boosted the sector at the start of the year. This was followed by President Xi Jinping's rare meeting with private sector business leaders and the National People's Congress prioritizing technology and the digital economy. These developments suggest regulators are turning more supportive of private businesses. They support our overweight stance on China's technology and communications services equity sectors and our opportunistic view on the Hang Seng Technology Index. The technology sector, in particular, is expected to see a sharp earnings recovery this year. Projected earnings per share growth for the technology and communication services sector are uh, rising are expected to rise to almost 58% and around 11% from a contraction of 14.5% last year and 31% last year. Now, while we remain neutral on China equities within Asia ex Japan on a 6 to 12-month horizon on deflation and tariff concerns, we see a slew of catalysts to support the growth sector stocks, especially these technology and communication services sectors that I mentioned. These catalysts are, besides the regulatory support for private businesses I mentioned earlier, potential fiscal policies to boost consumption, and the integration of AI functions across businesses, which are likely to support revenue growth across e commerce platforms. Meanwhile, China's communication services sector remains inexpensive despite the valuation re rating since mid January. This sector is still trading at around a 12% discount versus the US, supporting our overweight stance on the sector.
Got it. Thank you so much, Rajat, for the insightful sharing. It has been a great discussion. And that's all we have for today. Thank you all for listening, and please stay tuned for our next episode.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.